Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We've just released our monthly India Market Outlook titled, Have We Turned a Corner? In today's podcast, we summarize our asset class views and address a key question for bond investors. Now, before we get started, a quick roundup of the past month. Indian assets have outperformed global peers as growth indicators improved, inflation trended lower, corporate earnings reported during the month remained in line with expectations, and foreign investor inflows continued to improve. Over the past month, the Nifty index rose 3.8%, outperforming the MSCI World, which rose 1.3%, and MSCI Asia ex-Japan, which fell 0.6%. The INR appreciated 0.1% against the USD, while the benchmark 10-year Indian government bond yield fell by 16 basis points to close at 7.05%, near the levels it was during the start of the monetary policy hiking cycle by the RBI. The RBI and major central banks are signaling a likely peak in policy rate, with early signs of disinflationary momentum emerging amid falling commodity prices. Indian equities valuation premiums are more reasonable than at the start of the year, but nevertheless, we believe volatility is likely to remain elevated as slowing global growth and tight financial conditions begin to impact demand and corporate profitability. With this backdrop, we maintain a balanced asset class outlook with a neutral weight across all major asset classes. In our assessment, the safe strategy, which we highlighted at the start of the year, still remains a prudent way to navigate the uncertainties of 2023. S in the safe strategy stands for secure your yield, A is for allocate to long-term value, F is for fortify against future surprises, and E is expand beyond the traditional. Now, moving on to individual asset class views, we maintain a neutral stance on Indian equities, as higher than average valuation premiums, both absolute and relative to peers, is counterbalanced by robust domestic growth and resilient earnings growth expectations. We maintain our overweight on large cap equities given relatively better macro fundamentals and a greater margin of safety in terms of earnings and valuations when we compare it with mid-caps and small-cap equities. Within sectors, we are overweight domestic sectors given a weak global macroeconomic backdrop and greater earnings resilience, and accordingly retain our overweight on financials, industrials, and consumer staples. We maintain a neutral stance in bonds as attractive absolute and real yields are counterbalanced by lower yield premiums, stretched medium-term fiscal position, and weak government bond and demand supply balance. In our view, government bonds and high-quality corporate bonds are attractive, offering high carry and a better risk-reward as financial conditions are likely to remain tight in first half of 2023. The RBI's recent pause on policy rates is a tailwind for bonds. Within bonds, we are overweight short maturity bonds given an attractive carry. We expect the 10-year Indian government bond yield could trade in a range of 7 to 7.5% over the next 12 months. Cash remains a neutral holding, and finally gold remains a neutral holding and a portfolio hedge against elevated inflation and equity market volatility. Now we'll focus on the implications of the recent decline in domestic bond yields for bond investors. For listeners who would have heard our Market Outlook podcast last month or read the publication, we'll recall that we highlighted that a pause in the rate hike cycle by the RBI is mostly positive for asset class performance, including bonds, as yields trend to trend lower. Post the RBI's 6th April policy meet, the yield curve has flattened, with the 2-year and 10-year Indian government bonds yield spread narrowing to 19 basis points from 31 basis points. The sharp fall in long maturity bond yields has been driven by a confluence of domestic factors such as 1. Market expectations of a likely policy pivot by the US Fed with the possibility of rate cuts later in the year as growth weakens. Second, the likelihood of domestic inflation falling within the RBI's medium-term target of 2% and 6%. Third, strong demand for bonds by domestic institutional investors like banks and insurers, with new supply of government papers muted amid lower borrowing from states. And fourth, sequentially tighter system liquidity keeping the short maturity bond yields firm. In our view, the yield curve is likely to steepen going ahead, with long maturity yields staying elevated due to the following reasons. 1. Heavy bond supply pressures, with the government's weekly borrowing at a high INR 310 to 390 billion in first half of fiscal year 2024, and over 70% of the borrowing skewed towards the long maturity bonds, which range from 10 to 40 years. Second, seasonality to drive favorable liquidity conditions for short maturity bonds as the government steps up spending in the later half of the year. Third, the RBI continues to intervene in the FX market to maintain marginal surplus system liquidity. Fourth, slowing global growth and receding inflationary pressures amid market expectations of policy easing in the second half of fiscal year 2024 is likely to support a decline in short maturity bond yields. And finally, low US bond yields in the later half of calendar year 2023 is an additional tailwind for domestic short maturity bonds given their higher correlation with US bond yields. Now, given this backdrop, we believe that the shorter end of the curve, which ranges from 1 year to 4 year maturity, offer a better risk reward. Our secure your yield theme remains a preferred fixed income strategy as bonds still offer an attractive income opportunity. That's it in today's podcast. In the next podcast, we will cover questions on Indian equities. Do reach out to your relationship manager for a copy of our India Market Outlook. Thank you for listening, and if you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.